Okay, folks, welcome back. This is our economic calendar for the week to come. On Monday, there's really an absence of anything for the dollar, euro, or British pound. On Tuesday, nothing again. The FOMC speaker is 6 p.m. That's a dead zone. We're not really going to be worried about that. So Monday and Tuesday, there's really no economic drivers slated for volatility injections. On Wednesday, 4:30 a.m., London Open. GBP, we have medium impact public sector net borrowing. 2 p.m., we have FOMC meeting minutes, high impact for the dollar. On Thursday, London Open, Euro, high impact French flash services PMI. And 3:30, we have German flash PMI. New York Open, 7:30 a.m. We have ECB monetary policy meeting accounts, and 9:45 a.m. we have flash manufacturing PMI for the dollar, medium impact. And Thursday marks the beginning of the Jackson Hole Symposium. Jackson Hole Symposium is a collection of central bankers and the wheelers and dealers in the financial sector. It can create some volatility in the marketplace based on what they say. Now, it's usually, you don't see like reporters in there reporting, but throughout the day, the speakers will, break and talk to individual reporters. But like, it's not like a setting where people are allowed to go in there with cameras and go nuts and do all that type of business. But it can create volatility, and you got to be very careful around these times, because anything that they say could cause reasons for the repricing to occur in a dramatic form. On Friday, we have Fed Chair Powell speaking at 10 a.m., high impact, obviously. If the Fed Chair sneezes, that's always a high impact thing. So day two, obviously, the continuation of the Jackson Hole Symposium, and it rolls into Saturday as well for day three of the Jackson Hole Symposium. So I got a question from one of our members, they're a new member, and the question was, and it's actually a good question, so why do I even go over this in the beginning on our weekly reviews? Like, before we go into a new week, I always sit down with you, we open up with this calendar, and what's the purpose? Like, what is the basis behind it? Like, why should you even care? Well, number one, it helps you anticipate volatility. Okay, so whenever we have these high impact or medium impact news events, it's important for you to anticipate things in the marketplace, so that way you're not surprised, you're not scared by something, you're not startled, like, where did this come from? In the retail realm, especially when I first started trading, I would always see these things, move the market in the bond market and the S&P market. Those were my two primary commodities that I was working with. I never really understood what was causing all those things until I went and looked at the economic calendar, and you can see everything is slated by date and time when these things occur. So when you hear me refer to an injection of volatility, okay, what that means is it's directly related to the economic calendar. It's designed to act as a smokescreen. There are people, if you started worrying about Forex, if you were thinking about starting as a trader back in, I guess, maybe the early 2000s, there was this big to-do about how companies, which they were all scams really, they would have this little like automatic system where it would flash you a setup, buy or sell, and it would get you in your trades. So it was like an automatic trader for you. And you would basically be gambling on this system's interpretation of what the report's going to be, or the direction of them. And I think if people were able to do a consensus on where they lost the most amount of money, it's in all these things, these scams. No one is going to be able to determine what these economic drivers are going to do. And in a recent interview I did in a podcast with, I just retweeted it this past week. I mentioned this in that interview as well, that my belief is that while interest rates are the fundamental driver, on a long-term macro stance, these short-term little things here, they're really just meant to disrupt short-term sentiment, and it causes an injection of volatility. It means it creates action, it creates momentum, it moves the market. And many times you're going to find that these reports are going to be, well, markers in price where if you look at it from a quote-unquote fundamental stance or view it from a perspective from the fundamental, it should be bullish or it should be bearish. What I want you to do is, this is the whole point of bringing this up in the recordings every week, I want you to go into your charts and annotate them with what the information was versus the actual. Okay, in other words, if we look on on Thursday, we have the French Flash Services PMI. You click on that little folder here on forexfactory.com in the calendar. It gives you an idea of what it is, what's the purpose of it, and all that business. Okay, and you have the actual, and you have the forecast number, and what it was previously. And they give you this right here. They give you the actual if it's greater. In other words, if the number is bigger, okay, than the forecast number, it's generally good for the currency. Okay, well, this is what we have here. We have the last time it was 52.2, and the forecast then was 52.7, and that was on July 4th of 2019. There'll be another one, released this coming week, August 22nd, and the forecast is 52.5. Okay, 52.5 is the forecast. What's the actual number here? Now, we're not waiting for that number to be given to determine a trade. We're just doing this in hindsight, because I want you to understand that it's not important to worry about these things over here. I want you to also annotate your charts and reflect on them at the end of the week. What was the actual outcome after that? What did they do? Okay, what did the central banks use in these reports with technicals to create a narrative? And then you'll start seeing how 100% these markets are manipulated. And it will be very hard for someone to sit down and defend fundamentals, because you can't defend them unless you're talking about it from a long-term macro, because to me, I think that's where its strength and only importance lies, on a fundamental long-term basis. You can't time the markets, okay, with fundamental short-term data responses like this. They're just going to create little blips and changing of sentiment, short-term sentiment. That's what I think they're used for, like non-farm payroll. Many times if you study non-farm payroll numbers the first Friday of every trading month, the number, okay, may reflect one thing in terms of bullishness or bearishness, and then all of a sudden the market screams the other direction. Okay, so it makes you wonder, like, well, what's the point of all this? Then that narrative of being random price action, then it's easy to grasp onto that as a retail trader or a less informed neophyte that comes in and think it's overwhelming, it's scary, they don't know what to do. By doing this every single week with you, your job is to go into the charts and study intensively what these effects were on price on the individual daily basis when it was reported, and then how it was used inside the weekly range. So that's really, I guess, I don't think I've ever really mentioned that. In fact, that's why I said it's a good question, because I felt that I led people to that understanding in my free tutorials, but I felt it was a really good question because no one's really asked me why do I even bother doing this with you all every week. The short answers are this. Number one, we are using it to anticipate volatility, so we know that there's going to be some kind of a wild whipsaw run on liquidity or a run back to fair value. Okay, and it's for your learning and edification by going into your charts and annotating them, what the numbers were and how it would be classically determined or perceived by traders as bullish or bearish, and then watch how the price action develops for that particular day and for that particular week. And that's the real benefit of doing it. Now, you probably will look at this and say, okay, well, then I'm not going to even worry with this because that sounds like a bunch of work. And you're not going to get what you wanted to get out of this mentorship then. If you think that way, You're not going to get everything that is available to you in your own development, because by you going in and studying your own notes, there's no better teacher for you than your own personal hindsight annotations in your chart, because that study journal is the best trading book that was never written. And I'll say that again. Your personal trading journal, the study journal, that book that you're writing every single day, every single week, that is the best trading book that has never been written, because it's completely applicable to you. It lines up with your thought processes because they were your thought processes. I can tell you how I think and how I internalize things in the internal dialogue that I use, but not all of you, and in fact, most of you, will not align with my thought processes. Even though I can teach you the same concepts, breakers, BISI, SIBI, volume imbalances, and the things that I haven't taught yet, all those things will be common language between us. But the way you internalize price on the specific time frame at the moment, when you sit down, I may see something in the daily chart that says, I'm going to wait for this. But there be maybe 50 or 100 of you that can see something on a 5-minute chart that you're comfortable with for trading for the next couple hours. Neither of those things are better than the other. It just means that by aligning your thought processes with statistical data, sample sizes, and examples, the only way you're going to get that is by doing the work of annotating your charts and studying it. Hindsight is your best self-teacher. I learned all this stuff by doing these very things. And it's important lessons because you have a record of it. And it's important because you can go back and see what you were thinking at that specific time, and then how that translates into what the market has done. And then you get a huge, I guess, uptick in your understanding and experience, because you get to tap into that every single time you want to. Pick up your journal for that month or however long you do your journals, and literally you are being able to relive that moment all over again, and it'll bring back memories that you aren't really necessarily going to be able to remember until you read your journal entry. That's why I said in the interview I did a couple weeks ago, it allowed me to communicate the wonderful power of having a journal, because your memory will dissipate over time. Like, you have to do things every 7 years. You should replenish your understanding of whatever you're doing, because something in our brain breaks off, okay, at the chemical level, okay? It breaks off over time. So you have to constantly cycle through your understanding and learning, or you will forget. It's a natural tendency. People that do this over and over and over again, even in their old age, they are able to still maintain their faculties because they are cycling through things that they have been grown accustomed to do. And outwardly, everyone else around them will think, well, they're not senile, they're not losing their mind, they're not doing, I mean, obviously there's things like Alzheimer's and they're real medical, treatable, and maybe not so much treatable in terms of curing it. But from a development standpoint, it's important for you to cycle through your learning. And the best way to do that is by using a journal. I can go back just as well as you will be able to relive these moments, and you are able to tap into other memories that may not even be closely associated to your trading journal. I had one when I was going through my journal this morning. When I woke up, I just grabbed a journal from November of 1992, and I just went to November 5th. And some of those quotes that I share on Twitter today, they were the very things, because I was excited that night. I told my family what I was going to do. I was going to get into trading. I was going to get wealthy, and I'm going to retire at 40. And they're like, okay, yeah, you'll be working the rest of your life like us. So the point is, the journaling helped me remember other things about that single day that were unrelated to trading. And it's an emotional adventure, because you can go back and relive moments in your life because of certain things that you wrote down. It'll cause you to remember and recollect the moment to time that you wrote that, and it'll also swirl up all the other things that were going on at that same time. And it was just a wonderful practice for your life. Forget trading for a moment. It's just a really good practice because you're going to forget a lot of things. And people today, we don't have cameras like we used to. When I grew up, we had Kodak cameras and Polaroids. And unless you had a Polaroid camera where it spits it out and you get like 10, I think of it, if I'm not mistaken, it's either 10 or 12 pictures, it might have been 10. Instant development. You shake it, airs develop, and then boom, you have your picture. They weren't really equipped to last very long. I have a lot of Polaroids that didn't hold up well over time. But if you didn't have a Polaroid, you had to take your pictures and turn the cartridge, into a Kodak development company or mail it into them, and then either they mail it back to you or you go and pick it up at the kiosk, the Kodak store, and then you have your pictures. Well, we don't have that anymore. You have your camera in your phone, but like I just recently was heartbroken because I had 4 Christmases recorded on my old iPhone, and it just gave up the ghost. It wouldn't it wouldn't let me get in there. And foolishly, I did not back it up. But I always thought, well, I have them. Ain't a big deal. It'll only take me a minute to just download them. But I never did it. And I lost all those. Those memories are all just in my head now. And I can remember a lot, but I'm going to forget a lot too. And it's a very emotional disappointment. With journaling, you won't have that problem, because it encapsulates, like a time capsule, your thinking, your emotions, the things that were going on at that moment, and it allows you to relive that anytime you want. And if you apply it to other things in your life, just do like I do two different journals. I do a market-related journal, and then I do a personal journal. And I do that for, like, I do a lot of meditation. I do a lot of sleep studies. I keep basically a dream journal, and it's just it's an important part of my life. And every time I dream, I wake up and I write down everything I remember at the dream. And I may not remember everything at the moment when I first wake up, and then when I go to the shower after working out, I'll remember certain things that I didn't remember immediately when I woke up, and then I'll apply it later. When I get dried off, go over to the journal again and fill in those things. And then when I meditate, I think about those things, and eventually that helps me do other things that I do in terms of meditation. It keeps me centered, it keeps me grounded, and to me, it's a wonderful tool. Back to this, because I know you're probably thinking, man, get back to this, Michael. When you have your study journal and you're annotating your charts with these particular reference points, and when the market should have volatility, you won't grow fearful of news events. You'll anticipate them. Now, one of the biggest fears, is not knowing what's going to happen. You aren't going to always know what the market's going to do at these times. Most of the time, you'll have a general feel for what they may want to do, and that's how we do our framework. What are they going to use on that kind of calendar to run liquidity or engineer liquidity? And you learn about that in the mentorship. But really great question. I was glad I was asked it. But the purpose is we're anticipating versus reacting. And we're not fearful because we know when they're going to likely increase the volatility in the market pair. So that's the purpose of why I do this, because I don't want any of you floundering through the week and then saying, wow, why did that just happen? Notice that doesn't happen in our group. Like, no one in the group on Twitter questions, not that you would know who they're in the mentorship, but you can tell who's not in the mentorship on my Twitter feed. But they'll ask me, wow, what's going on with so-and-so pair? Well, anytime that's ever happened, I always tell them, look at the economic calendar. And it just goes right on top of their head. It's important for you to be balanced and not have a sense of fear or a sense of greed. This economic calendar helps you thwart fear, because you won't be surprised. You're going to anticipate momentum picking up and volatility coming in, and that volatility is a smokescreen most of the time. Now, there's going to be times when you're going to see these economic calendars have reports that the data reflects it to be bullish, and it might very well be bullish, but how long does it remain bullish? That's your study. You look at what we're doing on a daily range and on a weekly range. Over time, how long? I don't know, because everyone's going to be different. but you should just do it every single week anyway. When you annotate your charts, take the information you get from these economic drivers here on the calendar, the time that the report comes out, that's the time you're annotating. Now, how do you annotate it? Personally, if I were to go back and do it all over again, I would have a 5-minute chart showing the hour before, the hour of the report release, and the hour after. So what does that mean? For this report here, 3:15 a.m. it's due to release, so I would have as much data on a 5-minute chart showing the 2:15 during the 3:15 to 4:15. Okay, so you have that whole the slot of time on a 5-minute chart. I would show it on a 15-minute chart and a 60-minute chart. That's all you need to worry about. And then at the end of the week, then you can work that into a 4-hour chart if it's applicable, but it may not be. That's all you do. Now, you're probably thinking, man, look at all these reports. I got to do that on every single one of them. Sure, absolutely. It only takes a couple minutes. Put a couple notes on there. The report was expected to be bullish based on the data, and there it is. You're not putting down your opinion. You're not forecasting price. You're just putting it in your chart, and then you're saving that in your trade journal. And I showed you in the mentorship, and if you guys can help me, I don't remember exactly where where the date was where I show you how to go in. It was a recent one, and I think it's spring or the beginning of this year. I showed you how to create an Excel file and a spreadsheet, how to start and maintain a trade journal, so that way you can do searches on by date versus drawing things out or printing. There's a lot of money involved with printing things. The ink's very expensive, but one of the biggest scams they got going right now, in my opinion. But if you keep it electronically, it doesn't take up a lot of space. Like, I have a lot of journals. They're leather bound, and they're my personal treasures. But they take up a lot of space. Like, I have to have its own room. Like, I have a library in my home, but then I also have a study room. It's my study den, and it's just for my dream journals and my market-related journals. And they're literally like bookshelves of them. So it doesn't fit everyone's lifestyle, and it's very costly because I spend about anywhere between $60 to $90 for every leather-bound empty journal because I want them to last. And a lot of you may not have that means of being able to invest like that in this. It's more efficient to go and start a spreadsheet because it doesn't cost you any space at all. Like, it's literally, you can keep it on a flash drive and back it up. There's a lot of different ways that you can store it and not have a whole lot of spatial needs to do so, because it's just data. So hopefully that was helpful to you. And then now we can move into the charts. All right, so I just want to start with the trading view chart on the dollar because it reflects the cash market. There's a little disparity between the futures contract delivery on the AVA demonstrated dollar index, because it's showing the September contract of the dollar index futures market, or closely to that price. And then this is the cash market for the dollar index. We had that rebalance of the volume imbalance here, and we mentioned how it traded away from that, and we were focusing on this area here for imbalance, and then there was a smaller area of imbalance in here. In the futures contract price, these are actual volume imbalances. But just think of where we're at right now. We have these old highs. We have this run on liquidity outside of these equal highs. We had initial drop down. We were concerning ourselves with the range between the high and the low here in the equilibrium. We said that if it trades down here, it needs to find support at the equilibrium. It would be better if it didn't. And when we go over to the AVA demonstrated price data, you'll see that it never even went down into the equilibrium of the dealing range high and the low on the futures price, but on cash, it did. The point at which, and I'll just focus on these equal highs here. Okay, these two equal highs. I'm going to keep the cursor so that dotted line on the chart stays there. We're basically at that range high again, and we just closed in the imbalance here. Okay, so look at that little 1, 2, 3 days it spent time above, and then quickly retrace back down into the range. This is the point which it makes it hard. I don't know with a great deal of certainty if we're going to leave the range again, or if we're going to stay in the range and then go lower. This is at that crossroads. We have to see what's going to happen. So I'm not playing breakouts. I'm not playing reversals. I'm not playing anything right now. I'm waiting to see what price is going to do, because on the daily chart, what they do at this juncture sets the tone for the next couple weeks. So I'm more inclined to wait and be patient and let them show me what they're running for. If we start to break down and go lower, there's no reason to go back down in here, because there's no real imbalance. It's been efficiently traded. So you can see all the wicks and tails. It's back and forth as it went up, closing in the imbalance here. So any movement lower, to me, and it starts to respect this, then we can have a real clear framework where now the top of this range, which we left it here for a run on liquidity above these equal highs, all this was is a return to fair value, which is above these equal highs, the top of the range. And then we could, if it starts to sell off, we could start to work towards the liquidity pool resting below here, and then make an attempt to get below here, which is also relative equal lows. A lot of money is lost trying to pick tops and bottoms in long-term price moves, and I'm not going out on a limb to do that for you. I'm not confident enough to do it, because I haven't proven to myself that I've figured that part out. And in 27 years, I've grown accustomed to not even worrying about it. So I know what I'm waiting for. I know what I'm looking for. And once it materializes in the chart, then you'll know about it. So let's go over to the AvaTrade demo account and pick up our analysis on the dollar from there. All right, so we have our demo account from AvaTrade, and the dollar index is shown here. And again, this is going to reflect as close as you can get to the futures price on the September contract of the US dollars futures market. And again, here's that volume imbalance that we didn't even fill in on the futures contract. We just found support at the old dealing range. And then last week, I changed tune. I was originally at the beginning of the week, like we did our weekly analysis last weekend, I was looking for the market to want to come down and rebalance in here, and then that divider here we mentioned on the equilibrium between the high and the low of this dealing range. I said it needs to come down here and find support if it goes there. It's better if it didn't. Now, it didn't. So on the long side, I didn't change gears until our Wednesday review. I said that we would look to see it want to go higher, and I was on the heels of this day here. So here's Friday, Thursday, and Wednesday. This price action here had me concerned that we would want to come out and rebalance this. And again, like I mentioned just a moment ago with the trading view chart for the cash index on the dollar, we're basically at the top end of that range here. If we trade through it, it needs to go through this run here. Otherwise, it's just a rejection block. It's formed here, which is the up close here, the last up close, the highest up close candle in the swing. That's your rejection block. So if it trades through that, it cannot be permitted to trade back below it. If it does, then it's most likely going to be making a run to break this equilibrium and then make a run on the equal lows here and an imbalance in here. Okay, so I'm waiting, just like I required more data to change my stance on the near-term weekly analysis. When we spoke on Wednesday, I changed my tune and said that we would likely see the euro-dollar trade lower and this move up into these areas here. We did that. We saw that. Now, again, I want you to think about what happened last week. My analysis was calling for one particular event. I wanted to see the dollar to trade to go lower. That was my anticipation. I was expecting to see it try to do that. It didn't. It showed an unwillingness to do that. So you either stick to your analysis and don't adapt and get burned, or you remain flexible and let the daily chart tell you what the narrative is. If it's finding an unwillingness to go lower here, and then we have this big candle here, above this candle's high, what's remaining? The volume imbalance here, because there's no body there, and there's no body here. Just the wicks are existing between these two price points. This candle's closed and this candle's open. That's the volume imbalance. We traded up into both. Now I'm back at a state where I have to see if we go outside the range again here, and it needs to trade above the rejection block and stay above it to be bullish. If we trade above this candle's close and trade back down into the range, I would interpret that as bearish. Now, here's the curveball. We have Jackson Hole Symposium this week, and I don't know what that's going to cause. And it can cause a lot of volatility, and it can do a whole lot of stuff. And you want to be watching the Japanese yen pair. This is one time when that pair will probably have a lot of volatility. I'm not going to comment on it because I don't touch the yen pairs. I'm just telling you these are the types of events that I got burned on trading yen. So just be cautious, because if you're a yen trader and you don't know what you're doing this week, you could regret that a lot. Okay, so we're watching to see what we do at this juncture. We don't care. We're not trying to play the breakout. We're not trying to play the top picking. We're not trying to do either one of those things. We're waiting for more information, because I'm more interested in seeing if we're going to make an established longer term run higher, which, man, that puts us in the 102, 105, 107 contention if that happens, or we're going to make a run running below here and clearing up this area here and run the sell side liquidity below here. Either direction, lots of pips available. The range expands beyond this 300-point range. We got to get out of this. And I'm not trying to play, musical chairs inside of a 300 pip range on the dollar index. I have other tools I can use to ferret out setups and not require this to leave the range. But I'm really interested in seeing what we do relative to those two conditions. I want to see if we trade above the rejection block, then I have a very finite framework. If it goes above the rejection block here, trades above it, I know it cannot go back below that and be bullish. If we trade lower from here, what defines the break in that? The rejection block on the upside. If it breaks that, then we're bullish. You see how I'm at a point at which I don't know which is plausible right now, because both could happen. And what does that mean? That's a 50-50 chance. I don't trade with 50-50. I want 80, 90% likelihood in my favor that the outcome is going to be one direction or the other. If I have 50-50 odds, that's like retail. I don't want to trade like retail. Everybody makes fun of ICT. I can't trade, whatever. I can't trade retail. And that's what retail mindset is. It needs to be heavily weighted in a directional bias for me to feel like I'm trading with institutional order flow, and then I'm comfortable, I'm confident. Then I'll go and tell you this is what it's going to do. Right now, I don't have that. I just told you, and again, if it went over your head, if it was too fast for you, the benefit of having this as a recording, you can go back and listen to me again. I define the two parameters that I'm waiting for, and I'm also telling you what changes that once it's established. So there's no going back and trying to form fit, no sugar fit, no whatever you want to call it. I'm on the line now. I have a specific condition that I'm waiting for on both sides. I have no bias right now. I've told you how I'm going to frame a bias based on unreleased data. I don't know what the chart's going to show on Sunday. I don't know what it's going to show Monday. I'm waiting. I want to see what it's going to do. I also know that if I'm going to trade this week, I want to be taking 80% off of whatever position I have right away when I get 30 pips. So if I can get 30 pips, I'm banking 80% of it, and then I'll leave the remaining portion on and then see if Jackson Hole Symposium has a continuation of that trade idea. It may not, but at least I have 80% of my trade collected at 30 pips, which is the minimum threshold for me on a week, and I can be comfortable with going into the end of the week with just 30 pips and be knocked out of the remaining portion. So what I just gave you there was something of a great importance, because I'm not looking at this week as saying I'm going to trade aggressively, capture the whole weekly range, and lead the majority of my trade on. That's not where we're at. We don't have that. Okay, Jackson Hole can create problems. Okay, it can really disrupt the current sentiment, and really I think that's really its designed purpose. So I don't want to hold too much in regard as a bias for this week. I'm more or less in a reconnaissance. Okay, I'm fact finding. I'm collecting data, and then I'm going to take that data and formulate an attack plan that may not even materialize this week. So this may be a week where I don't do anything. Are you prepared for that? Are you prepared to do nothing sometimes? Because this is a week where I'm okay with doing that. And I'm telling you up front, I may not have a trade example to show. Here's what I did this. And okay, big deal. It's 1 week. Remember, we are in August. This month, I can't stress it enough. This month is such a curveball. It's in my experience and in my opinion, this month has the lowest likelihood of seeing what I expect to see in price unfold. And it's like that every single year I have that mindset. Now, again, as I said, I think I mentioned it last time we were talking, or the week before, that this month generally is a month where I try to do as little as possible, because I don't want to push myself in a situation where I know if I take a trade and I lose, I already knew better. Like, I shouldn't be doing it at all. But I'm operating a mentorship, so I have to tell you the reasons why I feel so strongly about this month. And I'm telling you the things in my mind before it happens, so that way you understand why there's certain things that are warranting caution for the month of August. There are times where my analysis in previous years in August, they were spot on. We have a lot of things going on right now, and the central banks are looking for the best way to screw everyone. And they're building a lot of sentiment one way or the other, this week with the symposium. So let that happen, and then we'll have a better, in my opinion, I'm expecting a better gauge on what we do going into September, when the markets get a whole lot more loose. It's very easy to see what they're doing generally from September, October, and November. They're just really easy months to trade. Ooh, that remains to be seen. But if you look at all my data in the past, generally those months are just really, really good for trading. And I'm trying to teach the element of patience with you now while you're going through this. That way, if I teach you this in the beginning, you won't depart from it later on when you're an individual trader outside of the reach of my instructions, or you're not worried about what I'm going to say about the markets. You're just going on your own steam, which is that's the goal. You don't want to be discovering all these things about August on your own and losing money. If you have live trading, and this is for your notes now, if you are trading live eventually and you're in August and you have 1 or 2 losses, take the rest of the week off. Come back the next week. If you have a losing week on the next week, right away, stop trading for that week too. Go into the next week and only trade like that in August and in January. I don't think you can squeeze December the same way, because December's iffy. You can still sometimes get a lot of movement in December, but I personally practice that too. So January, August, and December are my months where if I was to be in a market and I took a trade, I had a loser, and I take another loss, I stop for that week. And I'd go back in the next week. If I have a losing trade there, I don't trade again. Because I know all of the pain and the loss that I incurred in these types of months, and specifically August. You just can't push it too hard in this month. And I don't want to say any more about it because I'm probably boring you at this point, but these are the things in the mentorship that are worth the money you're spending. Because if you keep from losing your money by not doing the things I'm telling you to avoid doing, okay, if you stick to that and you don't lose money, you've paid for the mentorship by itself. Just doing that. Finding trades and making money is the easy part. Keeping your money is the hard part. And the way you blow it is you push it too hard in certain times of the year and you get impulsive. Don't get impulsive in August, okay? So I've said enough about that. Let's go over to Euro Pound. All right, so we have our Euro Pound daily chart here. I'm going to zoom out just a little bit. Bring your attention back to these equal highs we mentioned last week. Okay, and the market did in fact run up into those. So these equal highs, that level here, we ran above that, purged that liquidity, and made an attempt to run lower. We have a little bit of an imbalance in here still. Traded back to an old high. Here on Friday. On Wednesday, when I mentioned that I'd be looking for a sell-off in euro, and I had a swing trade on cable short relative to the fair value gap on the daily chart for British pound versus USD. On Thursday, the way we traded on euro pound gave me the inclination that I was offside on the long on GBP USD. You saw me share with you all the trade being stopped out on the balance after taking partial profits. So even though I was wrong on the trade, it was still a quote-unquote profitable endeavor. The euro setup panned out handsomely based on this pair's unwillingness to go higher and retracing lower. We have a liquidity pool resting below this low here at 90.88. Remaining BISI, it's all this candle here, right below this low. We could see it trade a little bit lower. We move into a hourly chart for this pair. CIVI trades back up into it, rebalance, sell off, fair value gap, trades up into the gap, sells off again. This one doesn't quite give it to us here. The high is 91.96. We didn't get that high on here, 91.94. So it didn't quite get up into that level. Then another sell-off into Friday. The underlying factors with the euro pound were the catalyst for why I took most of the trade off on the short on GBP and lowered the stop. And then you saw the stop got tagged. So again, everything that's shown here, if this pair is going to drop, okay, if it's going to drop, and I gave you a clear outline on euro dollar wanting to go lower, as we'll talk about in a minute, and I shared with you I had an open swing position on cable. If this pair is wanting to drop, that means that I have a strong likelihood of a euro dollar sell-off, which I had, and a consolidation on cable, which it didn't support that. So if it didn't want to drop, it was going to stop me out and run against me aggressively, causing the euro pound pair to decline. And that's the factor that led to me lowering the stop loss, reducing the exposure, so that way even if I got tagged on it, it wouldn't put me in a losing situation or transaction. And I took the bulk of the trade off in my first partial. So that blending of things here was stemming from this pair here in the analysis that I'm sharing. So let's go over to euro dollar. All right, so here is the setup. We went into last Wednesday talking about it here, and I said that we would see, I didn't have this notation here, that's all for the benefit of hindsight. I'll take this off for a moment. So at this moment right there, when that candle closes, okay, when that candle closes, it's done. The Asian range is formed. You can do your standard deviations and pull out where certain factors would line up for a turning point. Now I outlined, and I'll give you another chart in a moment, but I just want to kind of show you this here. Here's our Asian range. I mentioned that we were trading here, demanded it trades higher first. It needs to go up before it goes down. So IPTA will seek a premium, and then once it trades into a premium, it'll want to roll over and go lower. There's an imbalance right here. Now we had this level trade too, and I'll put the fib only on for the purpose of defining the initial fair value gap. And what I'm looking at is this high and this low. So equilibrium is right here. We fell just short of that. So the consequent encroachment never got tagged. So we have the remaining portion of this high, which is at 111.51, to the low of 111.55. So it's a matter of only 4 pips. Now, are you thinking, like, man, that's not that big of a deal? It is a big deal when you place it in proper context. Go back and watch the recording. I even shared it on Twitter as a means of being transparent. This fair value gap closes on this low. So if we have a line placed on that low, the low being 111.55 and 3 pipettes. So I want to be fair and precise about the level. You all know what this is, a fair value gap. So now we bring in the standard deviations on the Asian range. This is 1 standard deviation. This is 1.5 standard deviation, 2 standard deviations, 2.5 standard deviations, 3 standard deviations, and so on. Okay, I drew your attention here. It doesn't need to come all the way back up to this price point because we are returning back to a daily breaker. I'll explain that in a second, but for the purpose of this chart here, just know that once we did once I rather laid the expansion tool on here, it highlighted 111.57. Oh, that's the text this here, but 111.57 and 8 pipettes. Okay, that's the level that projected it. Now, this annotation here is me just telling you what was being projected based on everything I've just told you. The factors with the euro pound, the factors with the imbalance needing to trade up first, and right in here was the fair value gap. So when you have a confluence of a PD array, in this case here, the PD array is the closure on the fair value gap, returning back to a daily breaker, so that's a higher time frame level, old high. Buy side liquidity pool resting right in here. So they kept it sideways and then traded it right up into, on this candle, 111.57 and 8 pipettes. You cannot get any better than that. The sell is anything above these equal highs to that level. There's the imbalance being refilled, but the overlapping on the level is 111.57. So where would your short be? Your short would be at this low, 111.55, which is the 5 level. So we calibrate our level to a 5 or a 0 level. Regardless of if it's 57 or 59 or 60, okay, you want to get that low-hanging fruit entry. Look how many times you get a chance to get it. On this candle, on this candle, on this candle, and this candle. And each one of these candles is a 15-minute candle. So over the span of 1 hour, you have multiple opportunities to have a limit order filled at 111 and 55, even. Go short there. Previous day's low, take some profits there. Expand down, projected daily low. You got to look at this 111 big figure, which is the round big figure that we mentioned as a drawdown on the daily objective. In other words, we are looking for it to run up and sell off and go down into that 111 big figure, which is a buy side liquidity pool. And I'll zoom in a little bit. But you also have an existing level below that, which will be shown in a moment here. Why 110.91? Why is that level being selected as a projected daily low? Because it's going to be below this old low, I'm sorry, the big figure 111, and it's below the old low that we're going to show you here. So scrub back here a little bit. Now again, this depiction here is just to kind of like show you what the daily chart looks like from open, high, low, close. So on Thursday, if you look at this right here, this open, rally up, find your sell signal in there, sell it, hold it. There's where it closes. So it opens, high creates of the day, and then runs lower. So this is power 3, and then come off the low, close off the low, up. That's power 3. When you're bearish, you want to be looking for the opening price, selling at that price or above it in high probability conditions. Or that's your best entry, to say it that way. Then the continuation will either run lower, below Thursday's low, and then reach for some measure of liquidity over here. Back into our 15-minute time frame. And again, that's all of us depicting what this entire Thursday's daily range looks like. This blue line and this blue line here just delineates the true day, which again is covered in core content. So you have the projected daily low. Let's see what that Thursday's low is. I mentioned over here, we would see the market want to close in this imbalance, and then we have a liquidity pool resting right over here. So below this low, we have this level right in here. And get to pop up here. Okay, so we have 111.01. What's 10 pips below that? 110.91. But the level is calibrated with the Fibonacci overlay, which is taught to you in the core content and also built upon with the model number 5, price action model number 5, once you're a charter member. And then we have this is that 111. Then we have 10.68, which is below these relative equal lows. So the next liquidity pool will be resting relative equal lows here. And again, that level is 110.68. And you can see it here. Now, I did not, because I'm really covering charter member level content here, but I'm sharing it across all of the access levels in the mentorship. But the standard deviations for Friday work out. You'll get the low as well on Friday. The importance of knowing these levels is only going to be appreciated once you understand the order flow. And I want to talk a little bit about that now. On Wednesday, I mentioned that we would shift gears and then we would want to go lower. Because remember, I originally was expecting the euro dollar to run above and challenge these relative equal highs here and a little bit higher on the daily chart. But everything changes, and intra-week we have to either adjust or get crushed. So on Wednesday, I changed gears. So, okay, we have a lot of factors. Now, the factors I've already covered with euro pound. All of those things were there. And I used all that insight and underlying pinnings of the market to facilitate this idea here. This is the combination of all of those factors coming together with elements of precision and using IPTA. So the interbank price delivery algorithm seeks a premium, then reprices to a discount. Not random levels, where the orders are. Above equal highs at a predetermined imbalance. Above the opening price. Opening price is right here. Extend that out through the day. You can see all the time we spent above that opening price. This is accumulation of shorts. This is the expansion move. Then we have the opposite end of the daily range forming at a predetermined logical level of liquidity using the stop grading of 10, 20, 30 pips. This level here, 111 big figure, that was cited as the downside, and you also know the protocol for that. If we trade down to a big figure, we don't expect it to stop dead on the big figure. There's going to be orders resting below that big figure. Now, factors involved with trading a big figure are this. We had an initial shallow sweep below that of about 10 pips almost. Okay, the low actually came in on this candle at 110.90 and 7 pipettes. Okay, so not even a half a pip or so in terms of variance from what we projected. The next day, it consolidates into initial portion of the day, and then we have Asia, and then moving into London. We have a repricing, attacking the liquidity below previous day's low, and then seeking the liquidity at the lower. Then we see price reaching down to that 110.68.9 level, which is, again, the liquidity resting below here, these relative equal lows. So it may require the next day to reach for the basically liquidity below a big figure, which is what we saw here on Friday. We have a nice displacement, and it trades down almost. Let's see what the low is. I gotta move this to get it. The low comes in at 110.69, so 30 pips essentially. Let's take this off now. It's done its job. 30 pips below the big figure, we see it sweep, and then we have a reaction. We're consolidating again. So right now, as it sits, there's a really nice fair value gap right in here. So be mindful of this one. Next week, I'm looking at that high right here, and then this low. Let me take that. Yeah. Yeah. So we have that. Now also, I'm going to go to the daily chart for a second because I'm going to outline this for you. I mentioned that we have the breaker here that I drew attention to as a potential area where you can come down and hit that and want to trade up into the buy side liquidity pool here if we had the weakness in the dollar, which we didn't get. So since we didn't get that, everything changed midweek last week, and we changed gears and went bearish on euro dollar. Keeping this as it is, we're going to drop back down into that 15-minute time frame and zoom out a little bit. Look what happens on Thursday. We trade right back up into that breaker. So the question I got on Twitter, I don't know if the member is a part of our mentorship or if he's just watching what I'm doing and piecing it together, but he said that he didn't feel that it rebalanced. This is a point of rebalancing. In fact, it's two premium arrays. We have the breaker on the daily that we were expecting it to provide bullishness. So if it's not going to provide bullishness, is the level insignificant? No. IPTA is always rebalancing premium to discount, discount to premium. If it passes through, which it does here, okay, passes through it here, it didn't offer support. And this is why the idea of support resistance is flawed. And the idea of supply and demand is flawed because you have to cut through candles. You have to cut through these candles here, or you'll never get the context here, because this shaded area that's being provided as the basis for an area for real tangible interbank resistance. Why is it going to be interbank resistance? Because there's going to be a large pool of liquidity. They're going to want to go selling short there. It's mitigation. This is where a logical area of buying should come in. If it does not occur there, it will return back here, and then it'll become an area of selling or going short. I'm going to zoom back out a little bit, and you'll see that's the beautiful response off that bullish breaker. And then this is what it looks like on a lower time frame, but it's framed on the daily chart. And I'll zoom back in. There it is, and there's a reaction to it. And it's also essentially leaving a fair value gap on the daily between this candle's low and Thursday's high. So if we do turn the corner and start to rally, it could still come up to this level here, rebalance that, and then dollar can continue going higher. And that could be the catalyst to go lower. So these are all potential levels. If we trade to that level, that's how I look at it, because we have a fair value gap and we have a breaker that has offered resistance there, and it may want to come back and reprice to rebalance that and then allow longer term sell-offs to form. But that's assuming it comes back up to that level. Now, what happens if we trade out to the level and I take a short and I get stopped out and we try and trade through it? If we come back down to that level again, this would be a reclaimed order block. It's a breaker, a bullish breaker, but it passes through it once, comes back, and comes back down to it again. So again, all that nonsense about cutting through candles, don't do that. Well, that's supply and demand. I don't trade supply and demand. I look through the kind of candles to build the context. IPTA has not forgot about this level. simply because it traded through it. You can see it on Thursday. Thursday's trading right up into it. Only went 2 pips above it. So everyone's daily high on Thursday is not going to line up with 111.57 and 8 pipettes. That's the reason why I asked publicly on Twitter, because I'm going to cite that now. Go back and look at my question on Twitter when I asked everybody, what's your daily high and low on Eurodollar? Not everybody's high and low agreed, but all of them would agree that if you look at this breaker, we traded back up into it, it provides that. So it's, again, it's not about knowing the absolute highest pip and the lowest pip. It's the general idea within 5 pips. I allow myself 5 pips of variance. I don't care to know I'm getting out at the absolute high or the absolute low, or getting in at the absolute high or getting in at the absolute low. I don't care about that. I want to get the meat between those moves. And if it's on an intraday basis, I know I can get 20, I know I can get 30, and many times I can get 50 pips if I can wait for it and allow the setup to come to me, not force it. So let's go back into the 15-minute time frame. So right now, this could have been displacement. They could have entered the market here and waiting for some level of rebalance. We have relative equal lows still. And we have another level of imbalance that could result in a fair value gap bullish order block right in here. So watch that this week. If we come down in here and time and price agree, SMT divergence, that could send us up into rebalance here. So that's something I'm watching going forward for euro dollar. If we roll through this, then obviously we're just going to most likely continue going lower into the 110s, low end 110.20. Now into the pound dollar. I was looking for this to expand lower. Looked like we had multiple reasons to see a expansion on the downside because they had sold the high end of the range several times. And yes, they're relative equal highs, and that was another reason I felt inclined to lower the stop and take a portion of my partial, a large portion off in the short I had on a swing trade basis. And you can see we did not hesitate. I mean, they just sent this thing up, raging against these highs. And we came back down into a bullish order block here, found some support. Then again, another expansion on the upside. So whether it was Brexit related, I'm not attributing it to that. I'm attributing it to the reactions and trading on the euro pound. Like I mentioned in the interview I did, I'm 80% technical, 20% fundamental. And I've already relatively exhausted my ignorance by telling you on the Brexit related aspects of pound dollar. I'm learning every single day. Anything that has to do with Brexit, I get a lot of questions like, what am I reading? What am I following? I'm really studying Brexit because it's all new information. And I think it's new for everyone. Anyone that claims they know what's going to happen or they figured it out based on fundamentals, they don't know what's going to happen. They don't know what the fallout's going to be. They don't know what the ramifications are going to be. And anyone that tells you different, they're full of crap. So that's where I'm doing most of my reading and studying. I read a lot of articles, and I try to digest as much information about it as I can. And I don't claim to know it. And you'll never hear me say, I figured it out. I'm not going to ever be able to say that because it's all new frontier. All right, so where are we going for cable? I've got to an hourly chart. I don't think that if we don't drop lower, if we do drop lower, we have a small little imbalance here. Let me zoom in. I got a little too much showing on the chart for right now. A little bit of an imbalance here down to a bullish order block, and then we have a little imbalance as well. And then we have the mean threshold of this down close candle, which overlaps both. So consequent encroachment of the fair value gap between these two candles here, which is this BISI, buy side imbalance, sell side inefficiency. So midpoint of the point between this low and this high is right here. And it's also overlapping with the mean threshold of the last down close candle. I don't look at this because it's the more beefier candle. I'm using that, not these, this. Split that in half, takes us to right here. So I already know some of you are new. You're probably frustrated I'm not doing it for you to see it. So I'm going to do that now. And There you go. I'm dropping the fib so it touches the bottom of this low, anchoring it to this high. So I'm looking at the range of this one single candle. Let me zoom in a little bit more. So this candle's high, this candle's low. I'm anchoring between the two. And I don't think I have it on there good enough. There we are. So we have the low here and the high here. Equilibrium, which is 50% basically. So if you take that, draw a horizontal line, drop it right on that level. Boom. It's also the mean threshold, which is the middle point of the last down closed candle. Split that in half, project that out in time, and it's also overlapping with consequent encroachment. So I really like this level here. If we do drop, we might get some response there at that 121 big figure. Hello, see how that overlapped? Now, it's not simply because it's a psychological level. It's not psychological, it's liquidity. And there's a lot of imbalance in here, and it becomes also a balanced price range because we have price trading down and price trading up. So efficiently, we have traded very nicely around that 121, but they may want to come back down and recapitalize 121 and pick up more orders, and they would do so by doing it in this imbalance right here. So IPTA may only want to reprice down to this price point here and not go lower. So if it does trade here and time and price overlaps and I get the complements of SMT, then I might take a long on pound dollar this week if we can get to that level. If it doesn't happen by Thursday, I'm not touching it because, again, Jackson Hole Symposium becomes a factor, and I don't want to be in there with that uncertainty. All right. Otherwise, didn't get a chance to say what the upside would be. If we go over here, we have this area. I like this one. My eye jumps right to this. It's also above these highs here. So we have a liquidity pool here that could expand up into this imbalance. So we have a SIBI, sell side imbalance, buy side inefficiency, and then that may be an upside draw. So if we get some wild, wicked volatility this week on the whatever would be mentioned as a result of the Jackson Hole Symposium, that could be a draw on liquidity for cable as an upside. Downside, don't know if it's going to be any more required than just to take these equal lows out and maintain this low. And I only say that because it would make sense if they're going to utilize all the smoke screen, and maybe they have priced in a low here, and maybe there's a high being priced in on dollar. They could be defending the August 9th, what is that, 10th? What is that? 11th. So the low on the 11th may be defended, and then we'll work a range and then expand that later on if it doesn't do it right away up here. So there's a lot of reconnaissance that I'm doing this week. I'm not trying to push anything. I'm not trying to sell a hard narrative to any of you. This is the context. I am waiting to see what they want to do. I am in no rush to jump in with a bias. I'm not in any rush to jump in with a trade. If I do no trades this week at all, I'm okay with it right away. I've given my permission openly, and I've shared it with you all. I have been very unsure, okay, about what we're doing in the dollar index, and I have to have that to be high probability. Now, high probability in the definition of what I shared in core content. There's other ways of trading, not requiring the dollar to leave that consolidation and then just work off of correlated pair SMT and time of day and just trade intraday volatility. You can do that, but that's all day trader specific. And I'm trying to really anchor a lot of the things I teach you and provide you by way of perception on the higher time frame landscape. I don't want to always try to sell the narrative of day trade. But day trading is the model that is really doing well now. And you have to either appreciate it and just wait for your longer term model and the conditions that support it to come into the marketplace, or just practice in this way of interpreting price on the lower time frames. And just know that it's the same stuff that's applied to the daily and weekly when it does allow for longer term price swings. Okay, so I gave you a lot. I gave you a ton of stuff in this video, and I know your head's probably swirling, but just know that everything I gave you is what I'm thinking right now. What are my sticking points? What are the things I'm looking for? What would bring clarity? What would negate a trading idea, what I'm specifically looking for, what levels I'm looking for, and what these levels would constitute in terms of my thinking and how I would utilize them. Okay, they're not trade setups, obviously. They're not a bias for this week either, because I hold no bias right now. I'm waiting for a bias to be determined by the marketplace, because as of right now, remember, I said this before, sometimes our bias is not going to be given to us on Friday's close. You require the Sunday opening, the Monday's trading, and then suddenly, and then sometimes not, you'll get more information about whether you take a trade or if you have anything setting up for an opportunity. Number one rule, preserve capital. Number two, wait for your setup. Right now, I don't really have a whole lot of setups that are panning out, and I don't have probabilities behind me because we're at a level in that dollar index that could go either direction, and that is 50-50, and I don't trade 50-50. So hopefully you found this insightful. I'll catch up with you guys by way of the forum intra-week, and just be careful. If you're a yen trader, Thursday and Friday could really do some damage to you if you don't know what you're doing. Until I talk to you next time, wish you good luck and good trading.